Hey traders, welcome back to the channel. If you are new here, my name is Prabhu and I have been trading for the last few years. My goal is to simplify trading so you can understand the market with confidence, right? In part 1, we covered the basics of market structure including trends, swing highs and swing lows. But now let's take it step further and learn, right? uh, how to spot trend reversals before they happen, the key signs of market structure breaks, how institutions manipulate retail traders, right? This is crucial information because most traders lose money by entering at the wrong time. Let's fix that today. Now, let's start with the story. In part 1, we learned how the market moves like a road trip with uptrends, downtrends, and sideways phases, right? But what happens if when the road suddenly changes? What if you are driving uphill thinking you will keep going up, but then boom, you hit a dead end and are forced to turn around. This is exactly how trend reversals happen in the market. Today, I will tell you a story about how big players trap retail traders and how we can avoid falling into their trap. Right? Now, imagine a mountain climber named Rahul. Rahul is climbing a steep mountain. He keeps going higher and higher. Everyone around him is excited, cheering, and even more climbers start following him. But suddenly, he reaches the top and the path ends. There is nowhere else to go but down. This is what happens at the end of an uptrend. The stock price has been going up, more and more traders are jumping in late, thinking it will go even higher, but then it reverses and crashes down. Why? Why? Because the big players, institutions and smart money have already exited and are now selling, right? So retail traders are the last ones to buy at the top, then they get trapped. This is called bull trap. How big players set the trap, right? How big players set the trap. Here is how institutions trick retail traders. They push the price up to attract buyers. Retail traders FOMO in, thinking the trend will continue. Institutions quietly sell their positions at the top. The price suddenly drops, trapping late buyers. The same thing happens in a downtrend, just in reverse. Imagine Rahul falling down the mountain. Everyone panics and traders sell out of fear. But just when it looks the worst, big players start buying and the market reverses upward, trapping all the sellers. This is called a bear trap. Now, how to avoid getting trapped, right? How to avoid getting trapped? So how do you avoid these traps and spot real reversals? Right? First one, look for weakness in the trend. In an uptrend, if the price fails to make a new high, be cautious. Be cautious. In a downtrend, if the price fails to make new lows, it may reverse. And second one is watch for institutional manipulation. If price suddenly spikes up and drops fast, it's often a trap. If price drops hard and then rebounds quickly, big players are likely buying, right? And third one is confirm with volume and structure. If the price is reversing but volume is low, it might be a fake move. And wait for clear confirmation before taking a trade. So summary is, the market is like a game. Institutions try to trap retail traders. Now, bull traps happen at the top and bear traps happen at the bottom. And always wait for confirmation. Always wait for confirmation before entering a trade. Right? Now, how to identify trend reversals, right? A trend reversal happens when the market shifts from bullish to bearish or bearish to bullish. But how do we know if a trend is truly reversing? So here are three key signs of trend reversal: breakup structure, and second, change in momentum, and third, volume confirmation. So breakup structure: in an uptrend, price fails to make a new higher high and breaks below the last higher low, right? In a downtrend, price fails to make a new lower low and breaks above the last lower high. And second one is change in momentum. A strong bullish trend suddenly slows down with smaller candles and long wick, or and in a bearish trend loses strength, showing indecision candles like doji or pin bars. So, and third one is volume confirmation. A true reversal is backed by high volume. If price breaks structure with a low volume, it might be a false move. So a tip is, a trend reversal is confirmed only when price breaks the last major swing level. So institutional manipulation and fake breakouts, right? Big institutions and market makers don't want you to win. They create fake breakouts to trap retail traders. Here is how they do it: liquidity grab or stop hunting. Price briefly moves above resistance or below support, tricking traders into entering too early. Then price reverses sharply hitting their stop losses. And second one is false breakout. False breakouts. Price breaks a key level, making traders believe the trend has changed. But instead of continuing, it reverses back inside the range, trapping them. And third one is manipulation wicks. Large wicks appear, showing that institutions are sweeping liquidity before making the real move. Right? The tip is always wait for a retest before entering a trade after a breakout. Right? Uh, Now, how to trade reversals and avoid traps. Now that you know how institutions manipulate price, here is how to avoid the traps and trade reversals profitably. So, step 1, identify a potential reversal with a breakup structure, and 2, wait for retest of the broken level instead of entering immediately. Third, step 3, check for confirmation with volume and candlestick patterns. Step 4, place a stop loss below the, the previous swing low for buys or above the previous swing high for sales. So step 5, target at least 2 times your risk to reward for a profitable trader. Right now, tip is the best reversals happen at the major support and resistance zones. Right? Alright. Now, traders, if you are finding value in these lessons, I have one small request for you. I work super hard to bring you real practical trading strategies that actually work. So if you're enjoying this content, please take a second to like this video, subscribe and share with fellow traders. And trust me, you don't want to miss what's coming next. In the next part, I will show you how to avoid the biggest mistakes traders make and how to spot high probability trade setups before they happen. So make sure to hit that subscribe button and turn on the bell notification so you don't miss it. You and before you go, I have a question for you. Do you prefer uh, breakout trades or pullback trades? Let me know in the comments below. I read and reply to every comment. Right? Let's try to hit 100 likes on this video. Once we do, I will drop a bonus strategy in the comments. Uh, this wraps up part 2 of our market structure masterclass. In part 3, we'll go deeper into advanced trading strategy, including how to use market structure for high probability trade setups. Right now, alright traders, see you in the next one. Happy trading. Thank you so much. Sign off.